Hello and welcome to episode 423 of the Money to the Masses podcast with your resident expert as always, Damien Fee, and me, Andy Leakes. Damien, how are you doing?
I'm good. It's good to be back another week, and thank you to all those people who left reviews. Don't forget, I'm going to ask up front this week, make sure you leave a review of the podcast because it's really motivating for the team when we get the reviews. We share them with the whole team, and also you could win yourself a Money to the Masses mug. So I'm pleased that I got that out there first of all in the podcast. When usually we do it at the end, don't we, Andy?
We do indeed. And I have to say, Damien, I was having a little rummage around Money to the Masses towers, tidying up a few nicks and crannies, and we've got loads of mugs. So please do get in touch, do your review and claim it, because we'll be more than happy to clear up a bit of space in Money to the Masses towers with a surplus of beautiful mugs that we've got in stock.
Before we move on, Andy, is there any bowls chat this week or any incidents?
Not really any incidents. I've been heavily involved in the bowls world in the last week or so. I've won a couple of games and we're doing quite well. I must admit, I'm enjoying bowls and village life. I really am. And I will be bringing to the podcast any bowls news as and when it arrives. But other than the fact that weather's been pretty good in the last week and I've won a couple of games, that's the update.
And I'm glad you're enjoying village life now, Andy, because since you've lived in the village for a few years now, all you ever seem to do is have a breakdown in utilities, whether it's broadband, water, electricity or gas. They seem to be never functioning. So up to this point, village life, you weren't selling it to me, but maybe bowls is going to be the thing that finally makes village life appealing. Right, I'm going to tell you what's on this week's podcast. 3 pieces. I'm going to be doing an investing piece in relation to gilts. Now, it is possible to lend to the government to make money. So in particular, if you're a higher rate taxpayer, gilts can be a way that you can make a decent return in the short term that can actually be better than what you can get in a savings account. I'll explain more on that, but also even if you're not into investing, it's a good piece because it will help you understand how bonds and gilts are priced. The next piece we're going to be doing is a piece on wills. There was an interesting story in the newspaper. Aretha Franklin, there was a court case, a ruling that came about because there'd been a will that had been found down the back of a sofa. Believe it or not, that sounds like it's made up, but that is what happened. And we're going to be looking at that and then discussing some broad takeaways or equivalents from UK law in relation to wills. And finally, Andy, you're going to be doing the last piece in relation to energy.
That's right, just a short piece on a new type of energy tariff that's hit the market this week, and there's likely to be more of them coming. It's a tracker energy tariff available from Octopus. So I'm going to explain exactly what that is and the pros and cons, really, so that you can work out if it's something that you might consider. So, Damien, let's get started then. We're going to start with our investing piece, and you're talking gilts.
Yeah, so if we take a step back, at the moment you can get some attractive savings rates. We've mentioned them on the podcast recently. Do make sure if you are looking for savings accounts that you look at our roundup of the best savings accounts at the moment. We'll put a link in the notes of this podcast, but we do update it every week with all the best rates. It covers everything from cash ISAs, fixed rate cash ISAs, variable rate ISAs, even fixed rate bonds. You get some very attractive rates now. You can get north of 6% on fixed rate bonds, and that's a result of the Bank of England base rate going up and market expectations of where interest rates are going to be in the future. So you can get 6.2% as I make this podcast for a 1-year fixed rate bond. Now, there may be people out there, particularly higher rate taxpayers, who may have used their cash ISA allowance, for example, and they are looking for other ways to make a return on cash and a way that isn't going to be taxed heavily. Now, I'm not going to be talking about premium bonds. That's something very different. Now, premium bonds are from the National Savings and Investments, and they work by you putting your money into them up to £50,000 per person, and your premium bonds are put into a prize draw. There are prizes that are pulled every month, and there are some top prizes. You can get £1 million, for example. But if you take all of those prizes and you add them together and you look at the amount of money that's paid into premium bonds, then you're getting a return of around about 4%. That's what it's going to be from the summer of this year, because it's just gone up. Now, I say you would get 4%. The way it works, because it's a draw, you don't actually get that return. You may hold premium bonds for years and never win a prize. But if you looked at all the prizes rises and the amount of money, then it notionally works out at 4%, and obviously it's tax-free. So we ignore those and put those to one side. And there was an interesting article that I read on Bloomberg, which I've using for the basis of this part of the podcast, which actually looked at the idea of, well, what about if you lent money to the government instead? So we're talking about gilts here. So a gilt is effectively a loan to the government. Do you get coupons that are paid in accordance with the bond or the gilt itself? You'll know that at the outset. So this is a potentially interesting way of getting a return that can be largely tax-free. As I said at the beginning, this is particularly interesting to people who are higher rate taxpayers. So people who are additional rate taxpayers where they're paying 45% income tax, and that means they're going to be earning north of £125,000, so £125,140. This is interesting. I'll go on to explain why. Now, of course, when you have savings accounts, you've obviously got the protection with savings accounts of up to £85,000 under the FSCS. Now, we'll put a link in the notes to an article that explains that fully, but that is per banking license. So if you get a bank like First Direct and HSBC, they share banking licenses. So that means that if you have more than £85,000 across accounts with both of them, then you're only covered up to £85,000 if they were to go bust. And that limit is doubled for joint accounts, so it's £170,000. But of course, if you give a loan to the government, it's underwritten by the government. So unless the UK government goes bust and doesn't repay the money, then you should get your money back. Now, what is interesting about gilts is that your majority of the income that you will get from gilt, or the return I should say, is from capital gains. It's not actually from the income, the coupons, the interest payments that you will get at regular intervals. And if you get that capital gain, it is tax-free. So that is very attractive. Now, you can hold a gilt in an ISA, so that can make the income that you do receive tax-free as well. And so for people who are trying to juggle tax allowances or trying to mitigate tax, then this is a potential way that they could perhaps get a better return on their savings. Now, the problem with gilt is that they are volatile in price. Now, I've talked about on the podcast in recent months and weeks about gilt and about how they performed in 2022. When interest rates rallied, they rose. When the Bank of England increased the base rate, gilts did terribly. In fact, gilts were one of the worst performing assets in 2022. But a gilt sensitivity to interest rate movements is dependent on its duration, and part of that is actually to do with the maturity date of that gilt. So how long till it matures? So if you've got a gilt that's a short dated gilt that is going to mature in the very near future, it means that you are going to get back the loan amount from the UK government, which you can pretty much assume that you will get, unless the UK government can't for some reason pay it, which is obviously incredibly unlikely. And so gilts are seen as a very safe way of getting money back and getting a return on them if you use short dated gilts. I want to give you an example to make this illustration, and in particular, it's good for helping people understand how gilts are priced and how their prices change over time. And it's the same principle for bonds as well. So it's useful in learning about how gilts and bond markets work. Now, I'm not encouraging people to go and invest in gilts, but if you hold a gilt to maturity, so we're talking a short dated gilt here, you are effectively locking into a rate that's going to be similar to a fixed rate savings account. But there is this tax advantage that I've already mentioned. If you withdraw before the gilt, so you don't withdraw, I mean, if you sell out of the gilt, you sell it to somebody else in the market, then you could potentially make a capital loss. So you've got to bear that in mind. You need to be able to hold the gilt until maturity. So if we give an example, if you look out there and look at the gilts that are in circulation, then there is an example that Bloomberg gave of one called the Treasury 0.625% 6th of July 2025 issue. So that means that there's a 0.625% coupon or interest payment on that particular gilt every year. Now, that doesn't sound very good, and that's not a particularly high rate of return, but you've got to realize that this was issued back in 2019 when you were getting, not even half a percentage point on your bank accounts or on your savings account. So that was probably attractive back then. What was interesting, when the bond was issued, its par value, so its face value was £100. But when it was issued, it would have been bought for £100 and 2p. So people would have paid a little bit more for it. Now that shows you that if an income stream is attractive, and because of that guarantee, people might pay a little bit more. And what would happen? They would get all the interest payments, those coupons, over the term of the bond until 2025, and then they would get their £100 back at the end as well. So that is why people would pay a little bit more for that bond, because actually when you worked out what their yield was, it was attractive based upon what interest rates were back then and what you could get in savings. Now, things have changed because the yield that you get, the income yield you get on a gilt, for example, depends on the price that you paid. So now in the open market, that very same issue of gilt will be sold, or could be bought for, I should say, for £91.35 rather than £100. And that's because obviously interest rates have risen and there are more attractive issues that pay a better coupon rate out there, or people get better rates in savings accounts. So at the moment, you could buy that issue for £91.35 and you will get a 62.5p a year income. We're basing it upon the £100 face value. That would give you a yield, an income yield of about 0.68%, which doesn't obviously sound very good. But if you hold on to that gilt until the redemption date, until that maturity, which is in 2025, at that point, you will have had 2 payments of that coupon, but you would also then get back £100, which is the original face value of that gilt. So if you do the numbers, by July 2025, you'll have had those coupon payments, but then you would get that £100 back. That means you've paid £91.35 for the bond now. 2 years later, you will be getting £101.25. You work out what the return of that is. That's the total return of 10.8%, or that works out at around 5.4% a year. But why that is also good is because most of that return comes in the form of capital gain, which isn't taxable. So that means that the post-tax yield for a 45% taxpayer is still around 5.15%. And don't forget that if you have money in a savings account, basic rate taxpayers get a £1,000 a year savings allowance. You can earn £1,000 a year in interest without paying tax. Higher rate taxpayers, that drops down to £500. Additional rate taxpayers, they don't get anything. So if they've used their ISA allowance and they have money in savings accounts, if you're a high rate taxpayer, you're going to have to be paying tax on any money that you make. Then this is potentially an attractive option for people who have the money to invest in a gilt and they hold it to maturity. That's the key. Now, you can buy gilts if you are interested. If you go to your platforms, Interactive Investor, for example, Hargreaves Lansdown, it is possible to invest directly into short-dated UK gilts. Now, you need to look at the maths yourself. You'd also have to check the cost, because these platforms do charge fees to invest in gilts, and that will impact your return. So it's an interesting idea that short-dated gilts can offer an attractive return when you take into account that income, but more importantly, the potential capital gain to maturity. So if you aren't interested in gilts, then that doesn't matter. But what you've learned is how the pricing mechanism works. So when a gilt price is set at the beginning, that par value, say £100 that I've given as an example, then over time that moves up and down. And the return an investor ultimately gets will depend on the price they pay, the coupons that they're going to get, and what price they sell at, or if they hold the gilt until maturity.
Okay, so let's move on to the next piece of the podcast then. And an interesting story cropped up in the news about Aretha Franklin when a newer version of a will was found down the back of the sofa. So it got us thinking, and we thought that would make a good piece for the podcast. Damien, you're going to run through a few nice to knows in terms of wills that's cropped up off the back of this.
So back in 2018, Aretha Franklin died, and the singer left an estate that was eventually valued at roughly around 4.6 million. And that included property, cash, gold, and of course her music copyrights. Now I say eventually was valued because it was valued at much higher than that. And by the time they obviously looked through debts and taxes that were owed, it got down to about 4.6 million. Now, subsequent to that, 2 different versions of a will were found. And one of them was found down the back of a sofa, which sounds like a story that would be made up, but it was true. And the jury had to look at the will and determine whether it was the final will of Aretha Franklin, because the two wills were different. And so we were talking about this in the office and saying how interesting that was, because they were looking at this will in America, deciding whether she'd written it and whether that would be justifiable, because obviously she'd written it on a piece of paper and it was found down the back of a sofa. Looking at the UK, obviously it's different rules, but what I want to do is first of all point you in the direction of episode 178 of the Money to the Masses podcast, because I talked about prioritizing your finances and the order in which you should tackle certain jobs, and one of them was writing a will. So I covered the importance of that, and lasting power of attorneys were covered in episode 179. So I'm not going to go over that today, but we'll put links in the notes of the show. But what I wanted to do is talk about the idea of what constitutes a will in the UK. And in theory, you could scribble your will on a piece of paper, but there are certain rules that need to be applied for it to be valid. Now, the first one is that it needs to be signed and witnessed by two adult independent witnesses who are not beneficiaries and who are present at the time that you sign your will yourself. And that should make it legally binding. Why that is now interesting, and I think this is coming after we made those podcasts, because the ruling came in 2020 because of the pandemic, and those episodes were recorded before that. It is now possible to legally witness a will remotely. So you could use something like Zoom or FaceTime to do it. And that's obviously because of the pandemic. So since the 31st of January 2020, it's been possible to witness a will remotely. Now, with that out of the way, that it needs to be witnessed, the other things are that there are standard ways of writing wills that are tried and tested, and they remove any confusion about what you mean in terms of language or if there's anything unusual in there. So there are ways around making errors, and that can be using templates. So you can get a template from a stationery shop, or you can get them online. They cost normally about £30, but they are the sort of thing, if you've got a very simple will, so you are leaving all of your money to a partner, for example, when you die, and vice versa, then yes, the templates can be useful. If you have anything more complicated than that, then you should really look up the services of a solicitor or a formal will writing service. So you should definitely use professional help to write your will. If you have property abroad, you're trying to reduce inheritance tax, you may have business assets, for example, or you may have foreign investments or bank accounts. They are just some of the reasons why you might want to use professional help. Of course, it will cost more, but it will be worth it in the long run. Now, if you are happy to write your own will, because you are obviously allowed to, make sure you cover the following points: that the will is signed and witnessed, as I've already explained. You need to check carefully all your spelling, especially names. So make sure that you are very specific. So for example, if you want to leave everything to your partner, then make sure you use their name in full. If you've got old wills, then make sure you destroy them, because that means there's no confusion. Even though the newest one will clearly supersede the old one, make sure that it states that it revokes the old one in your new will. Tell your executors where the will is going to be kept, so they'll need to know where that is when you die. So don't just put it down the back of the sofa and hope somebody stumbles across it. Make sure people know where your will be. If you die, then they know where to find it. And what are the risks that if you write your own will? Now, there are risks to doing your own DIY wills, and that's obviously you could make mistakes. You can make it invalid by not signing it, for example. So if you do make an error, then your family could be left with legal expenses, having to try and challenge things, which therefore means they will end up inheriting less money. People might not receive the things that you want them to. And this is particularly important when it comes to making a will, when you're stating who you want to look after your children. Also, be aware that if you use a will template, the company that supplied the template do not take any responsibility for your will being correctly made. And so you've got the option of being completely DIY, where you do it yourself, maybe use a template, or you could go and see a solicitor. Of course, you can use an online will writing service. There's Which Wills and Fair Will, both services we do reviews of, or we've written reviews of, where we'll link to those in the notes of this show, where you can read the reviews and you can also see the offers. So we've got special offers with each of those that can get you reduced wills. So the last thing I just want to quickly mention is that obviously when you're writing a will, there is something called a letter of wishes, which you can have alongside your will, that give your executor executors an expression of your wishes of how you want certain things done. It could be how you'd like your children raised, for example. We'll put a link in the notes of the video with a little bit more information on that. So there you go. The Aretha Franklin story was a very good reminder of what the rules are in the UK and the things you need to do if you want to make a will. You understand why, we've already covered that, but these are the things you need to do to make sure that the will is valid.
Okay, so let's move on to the final piece of the podcast then. And it's just a short piece to talk about an energy tariff that's been relaunched to the market from energy firm Octopus. And it's called the Octopus Tracker Energy Tariff. And the reason this is interesting is because the tariff tracks the daily wholesale price of gas and electricity, which of course, if you've followed energy markets in recent years, wholesale prices of energy and gas have been astronomical. And that's why we've had regular changes to the energy price cap. We've had the government intervene with the energy price guarantee, but energy prices are starting to come down. So it now begs the question that rather than fixing an energy tariff, is it worth looking at an energy tariff that tracks the daily wholesale price of gas and electricity? And so Octopus have released the Octopus Tracker Energy Tariff, and we crunched the numbers. And we've actually written an article reviewing this energy tariff, and we'll put a link to that in the notes of this podcast. And so we compared the price that you'd pay if you were capped by the energy price cap versus the price that you would pay if you were on this tariff where it tracks the average wholesale price. And in the first week of July, you would have saved money. And so potentially it looks like it's a good bet. However, energy prices, as we know, are quite volatile. Prices can go up quickly and very steeply. And so you need to be aware if you're on this tracker tariff, that is one of the risks. And so looking at the pros and cons, not just of this tracker tariff, because I'm sure there'll be more from other energy suppliers. What are the pros? Well, you can access lower rates than the energy price cap if wholesale prices are low. If you don't have a smart meter, you can potentially apply for one of these tariffs and you will likely be able to access a free installation of a smart meter. You are afforded some protection on these plans. So one of the pros on this particular one from Octopus is it will cap the daily price. For both gas and electricity, it's 100 pence per kilowatt hour for electricity and 30 pence per kilowatt hour for gas. Obviously, that's way higher than the energy price cap. And so you are afforded some protection there. And there is no exit penalty should you want to leave that tariff, which is a good thing. Some of the fixed price tariffs that you see on the market, there are penalties for leaving those fixed price tariffs early. So what are the cons then of a tracker energy tariff? Well, they obviously track the daily wholesale price. And so you could be hit with much higher energy costs, and you don't necessarily know how long that will be for. Another con is if you want to switch to one of these plans and you haven't got a smart meter, you can switch, but you may have to wait quite a few weeks for them to install that and for the smart meter to start working and tracking and recording it correctly. So there could be a delay if you don't already have a smart meter. And finally, access to these tracker tariffs are quite limited. For example, the Octopus version, it was initially open to just 50,000 customers and that was quickly filled up. The website then switched off, effectively accepting new customers, and people had to join the waiting list. So you do need to be quick if you want to be on one of these tracker energy tariffs. So there we go. Tracker energy plans, they are a thing. We'll probably see more of them in the future. You'll need to think carefully before you switch over because they can be quite volatile, but often you'll be able to switch out of them without penalty. One to think about.
So that is it for this week. As ever, do leave a review of the podcast as I asked at the start of this show. Also, don't forget to join us on our socials. Join our Facebook group, facebook.com/groups/money to the masses, particularly Instagram. That's where I seem to spend a lot of my time. And I'm now on Threads. So the new social media platform, which is a lot better than Twitter. I'm starting to write things on there, which include ideas, tips, the sort of thing that you might hear on this podcast that I'm putting as threads on there. So I'm going to do something a little bit different, I think, with that new platform. So you could go on there and find lots of information about all sorts of things to do with money. Please do follow us and communicate with me on there. So Andy, that only leaves us to say until next time.
Until next time.